Hi everyone, welcome to my channel. Obtaining affordable healthcare insurance is one of the greatest challenges facing all small business owners. This video explains tax-advantaged method of buying health insurance called Health Savings Accounts or HSA. What are health savings accounts? Health Savings Accounts, or HSA, is tax-advantaged method of buying health insurance that has been available since 2004. Instead of relying on health insurance to pay small or routine medical expenses, you pay them yourself. To help you do this, you establish a health savings account with a health insurance company, a bank, or another financial institution. Contributions to the account are tax deductible, and you don't have to pay tax on the interest or other money you earn on the money in your account. You can withdraw the money in your HSA to pay almost any kind of health-related expense, and you don't have to pay any tax on these withdrawals. In case you or a family member gets really sick, you must also obtain a health insurance policy with a high deductible. In 2019, at least $1,350 for individuals and $2,700 for families. The money in your HSA can be used to pay this large deductible and any co-payments you're required to make. The premiums for your high deductible health insurance policy should be lower than those for traditional comprehensive coverage policies or HMO coverage. Establishing an HSA. You may individually establish an HSA for yourself and your family and pay for your health insurance with personal funds. Alternatively, if your business is a corporation, an LLC, a partnership, or an LLP, you can have it establish an HSA for you and make contributions to your HSA on your behalf with business funds. To participate in the HSA program, you need two things: a high deductible health plan that qualifies under the HSA rules and an HSA. HSA qualified plans. You cannot have an HSA if you're covered by health insurance other than a high deductible HSA plan. For example, if your spouse has family coverage for you from his or her job, so you may have to change your existing coverage. However, you may get your own HSA if you're not covered by your spouse's health insurance. In addition, people eligible to receive Medicare may not participate in the HSA program. You need to obtain a health plan that meets the HSA criteria or HSA qualified. The key feature of an HSA qualified health plan is that it has a relatively high annual deductible, which is the amount you must pay out of your own pocket before your insurance kicks in. In 2019, the minimum annual deductible for individuals was $1,350 and $2,700 for families. You can have a higher deductible if you wish, but there is an annual ceiling on the total amount you can have for your deductible plus other out-of-pocket expenses you're required to pay before your health plan provides coverage. Such out-of-pocket expenses include co-payments, but do not include health insurance premiums. In 2019, the maximum limits were $6,750 for individuals and $13,500 for families. This means that your annual deductible and other out-of-pocket expenses you're required to pay before your insurance kicks in cannot exceed that amount. So if your annual deductible is $3,350, your other annual out-of-pocket expenses would have to be limited to $3,400. These numbers are adjusted for inflation each year. In addition, your health insurance plan must be HSA qualified. To become qualified, the insurer must agree to participate in the HSA program and give the roster of enrolled participants to the IRS. The premiums you pay for an HSA qualified health plan are deductible to the same extent as any other health insurance premiums. HSA account. Once you have an HSA qualified health insurance policy, you may open your HSA account. An HSA must be established with a trustee. The HSA trustee keeps track of your deposits and withdrawals, produces annual statements, and reports your HSA deposits to the IRS. Health insurers can administer both the health plan and the HSA. However, you don't have to have your HSA administered by your insurer. You can establish an HSA with banks, insurance companies, mutual funds, or other financial institutions offering HSA products. Whoever administers your account will usually give you a checkbook or a debit card to use to withdraw funds from the account. You can also make withdrawals by mail or in person. When you have your HSA qualified health plan and HSA account, you can start making contributions to your account. There is no minimum amount you are required to contribute each year. You may contribute nothing if you wish. However, there are maximum limits on how much may be contributed to an HSA each year. If you have individual coverage, the maximum annual contribution is $3,500. If you have family coverage, the maximum annual contribution is $7,000. These figures are for 2019. They are adjusted for inflation each year. Taxpayers who have HSAs may make a one-time tax-free rollover of funds from their individual retirement accounts to their HSAs. The rollover amount is limited to the maximum HSA contribution for the year, minus any HSA contributions you have already made for the year. Optional tax-free catch-up contributions can be made to HSAs for individuals who are 55 to 65 years old. At age 65, most Americans lose HSA eligibility because they begin Medicare. This rule is intended to compensate for the fact that older people won't have as many years to fund their accounts as younger taxpayers. Withdrawing HSA funds. If you or a family member needs health care, you can withdraw money from your HSA to pay your deductible or any other medical expenses. You pay no federal tax on HSA withdrawals used to pay qualified medical expenses. However, you cannot deduct qualified medical expenses as an itemized deduction on Schedule A of Form 1040 that are equal to the tax-free distributions from your HSA. Qualified medical expenses are broadly defined to include many types of expenses ordinarily not covered by health insurance, for example, dental or optometric care. This is one of the great advantages of the HSA program over traditional health insurance. HSA participants need not obtain advance approval from their HSA trustee, whether their insurer or someone else, that an expense is a qualified medical expense before they withdraw funds from their accounts. Your HSA trustee will report any distribution to you and the IRS on Form 1099-SA. Distributions from an HSA, Archer MSA, or Medicare Advantage MSA. You should keep records of your medical expenses to show that your withdrawals were for qualified medical expenses and are therefore excludable from your gross income. If you withdraw funds from your HSA to use for something other than qualified medical expenses, you must pay the regular income tax on the withdrawal plus a 20% penalty. So for example, if you were in the 24% federal income tax bracket, you would have to pay a 44% tax on your non-qualified withdrawals. Once you reach the age of 65 or become disabled, you can withdraw your HSA fund for any reason without penalty. If you use the money for non-medical expenses, you will have to pay regular income tax on the withdrawals. When you die, the money in your HSA account is transferred to the beneficiary you have named for the account. The transfer is tax-free if the beneficiary is your surviving spouse. Other transfers are taxable. If you elect to leave the HSA program, you can continue to keep your HSA account and withdraw money from it, tax-free for healthcare expenses. However, you won't be able to make any additional contributions to the account. Health insurance ordinary may not be purchased with HSA funds. However, there are 3 exceptions to this general rule. HSA funds can be used to pay for a health plan during any period of continuation coverage required under any federal law. For example, when you are terminated from your job and purchase continuing health insurance coverage from your employer's health insurer, which the insurer is legally required to make available to you under COBRA. Long-term health care insurance, or health insurance premiums you pay while you're receiving unemployment compensation. Should you get an HSA? It depends. HSA appears to be a very good deal if you're young or in good health and don't go to the doctor often or take many expensive medications. You can purchase a health plan with a high deductible, pay lower premiums, and have the security of knowing you can dip into your HSA if you get sick and have to pay the deductible or other uncovered medical expenses. If you don't tap into the money, it will keep accumulating free of taxes. You also get the benefit of deducting your HSA contributions from your income taxes. And you can use your HSA funds to pay for many health-related expenses that aren't covered by traditional health insurance. If you enjoy good health while you have your HSA and don't have to make many withdrawals, you may end up with a substantial amount in your account that you can withdraw without penalty for any purpose once you turn 65. Unlike all other existing tax-advantaged savings or retirement accounts, HSAs provide a tax break when funds are deposited and when they are withdrawn. No other account provides both a front-end and back-end tax break. With IRAs, for example, you must pay tax either when you deposit or when you withdraw your money. This feature can make your HSA an extremely lucrative tax shelter. You must report to the IRS each year how much you deposit to and withdraw from your HSA. You make the report using IRS Form 8889, Health Savings Accounts. You'll also be required to keep a record of the name and address of each person or company whom you pay with funds from your HSA.